Chapter 2. Understanding futures. Futures contracts are financial instruments that allow investors to buy or sell an underlying asset at a specified price and date in the future. Futures trading is popular in the financial markets as it offers investors the opportunity to hedge against potential losses or to speculate on the price movements of the underlying asset. Types of futures contracts. Commodity futures. These are futures contracts based on commodities such as gold, silver, crude oil, wheat, and corn. Commodity futures are popular among investors who wish to hedge against fluctuations in commodity prices. Currency futures. These are futures contracts based on currencies such as the US dollar, euro, yen, and pound. Currency futures are popular among investors who wish to hedge against fluctuations in currency exchange rates. Index futures. These are futures contracts based on stock market indices such as the S&P 500, Nasdaq, and Dow Jones. Index futures are popular among investors who wish to hedge against fluctuations in the stock market. Interest rate futures. These are futures contracts based on interest rates such as the LIBOR rate, Fed fund rate, and Treasury bonds. Interest rate futures are popular among investors who wish to hedge against fluctuations in interest rates. How futures trading works. Futures trading involves buying or selling a futures contract. A futures contract specifies the details of the underlying asset, such as the quantity, quality, and delivery date. The buyer of a futures contract is obligated to buy the underlying asset at the agreed-upon price and date, while the seller is obligated to sell the underlying asset. Futures contracts are traded on futures exchanges, such as the Chicago Mercantile Exchange, CME, and the New York Mercantile Exchange, NYMEX. Futures contracts are standardized and traded in units, with each unit representing a specific quantity of the underlying asset. Margin requirements in futures trading. Futures trading requires the payment of an initial margin, which is a percentage of the total value of the futures contract. The initial margin is paid to the broker to cover potential losses. The amount of the initial margin varies depending on the underlying asset and the futures exchange. Advantages and disadvantages of futures trading. Advantages of futures trading include hedging. Futures trading allows investors to hedge against potential losses by locking in the price of the underlying asset. Liquidity. Futures contracts are highly liquid, which means they can be easily bought and sold. Leverage. Futures trading allows investors to control a large amount of the underlying asset with a relatively small amount of capital. Disadvantages of futures trading include risk. Futures trading is risky as the price of the underlying asset can be volatile and unpredictable. Margin calls. In futures trading, investors may be required to meet margin calls, which can result in additional capital requirements. In conclusion, futures trading offers investors the opportunity to hedge against potential losses or to speculate on the price movements of the underlying asset. It is important to understand the different types of futures contracts, how futures trading works, and the advantages and disadvantages of futures trading before investing in futures contracts. Additionally, investors should carefully manage their risks and follow a disciplined approach to futures trading.